Hey everyone, so I wanted to talk about proper pricing and ranges. Essentially, what a range is BFIs stacking orders. BFIs are banks and financial institutions. So, what happens is their orders are so large they can't actually fill them in one go. So, what they'll do is they'll start taking sells and buys and they'll create a range and basically park price till they've acquired enough positions. Whether it's 50,000 lots, 30,000 lots, 100,000 lots, I have no idea. But they can't just go ahead and put in an order for 50,000 lots of euro because the market actually won't have the liquidity to fill that. What that means is if they want to buy $1 billion worth of euro USD, somebody needs to be selling $1 billion worth of euro USD. And their orders being as large as they are, a lot of times the liquidity is not there. So what they'll do is they'll start taking buys and sells, and basically this will continue going through this whole range until they've acquired enough positions. They're basically generating their own liquidity. Basically, they're selling to themselves because BFIs have that much money and they have the ability to generate their own liquidity. And all we're trying to do is not be in the middle of all this. So this is where premium versus discount pricing is going to come in. If you are trading a range, because a lot of times you will be if you're a day trader, you're only going to want to buy from the bottoms and you're going to sell from the tops. So the bottom's called discount pricing, the top's called premium pricing, and we'll get into this in a little more detail. I just want to finish explaining a range. So once all their buys and sells have taken place and they've acquired enough positions, let's say 50,000 lots is the desired amount, and they're running a buy program, what's going to happen is they're going to leave this range and initiate their price moving away. What happens at this point is all the buy orders they took are now in profit. However, all their sell orders are in drawdown. So what they'll then do is push price back down and they'll start dumping their sell positions wherever. Some will be at a loss, some will be at break even, and they might even get a little bit of profit on a few of them. They don't really care about those. All they care about is getting out of their sell positions. Then they'll hit a demand zone, and ultimately what will happen is then price will begin. And they'll basically keep holding their buy positions and start selling them off towards the top. And whether that's days, weeks, months, nobody really knows. They hold them much longer than we do. When you have the ability to generate your own liquidity, you can sit on these positions for months without it really costing you any money. So this is where premium versus discount pricing comes in. A lot of times we are trading a range, so if you are going to be involved in a range, the idea is to get a decent price for your investment. So let's just talk about that a bit. So you have premium pricing, relative equilibrium, and discount pricing. And just so everybody can see my fib numbers, the orange line is 50%, that's equilibrium. 10% on either side of that is still relative equilibrium. And what that means is essentially anything in here is fair value, whether you're buying or selling. If you want a great deal on your sells, you want to be anything above 50% is a great deal for a sell. Anything below 50% is a great deal for a buy. So you're buying a discount, you're selling a premium. And the higher you get your pricing when you're selling, the better. The lower you get your pricing when you're buying, the better. But the fib basically just lets us know if we're getting a good deal or not. So to put that into action, you'll run it from the impulse where it begins to the impulse ending. And essentially what you're looking for is to get into the relative equilibrium territory. And once you're at this point, you are getting a fair value, which means you're not overpaying for your investment. But the lower it goes, the better deal you're getting on your investment. And once your investment moves up in price, you start liquidating your positions. The same thing happens in the sell scenario. You pull from the top of the impulse to the bottom of the impulse, and essentially you're wanting at least relative equilibrium for your sell position, preferably above 50% if that's possible. The market's not always going to play out perfect where the fib works for you every time, but a lot of times it will. So here you can take your sell positions and start dumping them once price gets lower. Again, the only purpose of the fib is to really keep you from getting ripped off. And what happens in the middle is actually where most of the orders get stacked. When we get on the real live chart, I will show you guys exactly what that looks like. And the idea is you want to stay out of that middle completely. Nothing good happens from it. So we buy from the edges, we sell from the edges if we're going to play a range. So the range I drew for you guys was equal highs, equal lows. This is a more realistic version of a range. And what they'll really do is just start shooting price up and down and basically park price. And what you really have here is a range from, wrong tool. What you have is a range from this bottom to this top. And essentially, anything that's completely in the middle, you're just going to want to stay out of, because they're just going to keep stacking liquidity, and every time they stack liquidity, they run it. They'll stack more liquidity, they'll run it, they'll stack more liquidity, run it one more time, and then ultimately they decide it's time to leave the range. I guess this would be a more accurate drawing of the range, but what you're actually looking to do is just avoid this altogether. You can take sells up here all day long, buys down here all day long, and at least you know you have a chance at your investment making you money. Whereas the middle, you don't have a very good chance. Now, once price decides to leave the range, it'll usually come back to the range as they're mitigating out of their positions. And this is where your best trade happens from. This scenario happens over and over on every time frame, on every pair, and we'll get into that a little bit more as I show you guys how pricing and ranges work in a real scenario. But for now, we'll cut this video here, and I will see you guys in the next video.